So, you're a stock market investor who wants to achieve financial freedom. You have a strategy, a portfolio, and a goal. You watch the market closely, buy low, sell high, and reinvest your profits. But you soon discover that the market is not playing by the rules. Is it controlled by greedy corporations, corrupt politicians, and shady hedge funds that manipulate the prices, create fake news, and short sell your stocks? You feel angry and betrayed. You wonder if you will ever be able to reach your financial dreams. Why is the market like this? The stock market is often seen as a symbol of free market capitalism and the ultimate vehicle for wealth creation. However, beneath the surface lies a complex web of players, tactics, and conflicts that can make it a rigged game for some and a complete nightmare for others. Let's dive into the dark side of the stock market and explore how it is often manipulated by a few powerful people to enrich themselves at the expense of ordinary investors and companies. We will examine how devastating the impact can be and has been on these victims and the society as a whole, and try to figure out whether there's an end in sight. To begin, let's meet the players who influence the stock market. First up, we have hedge funds. Hedge funds are private investment partnerships that pool capital from wealthy individuals and institutions to make bets on the stock market and other financial instruments. They are different from other investment partnerships like mutual funds because while mutual funds are regulated, available to the public, and have restrictions on their trading activities, hedge funds have more flexibility, are private investments, and can use complex and risky strategies, such as short selling, options trading, and leverage. So, you can already begin to see things could work well for hedge funders. The main goal of hedge funds is to generate high returns for their investors, who typically pay them a management fee, usually 2% of their assets under management, and a performance fee, usually 20% of profits. And considering that hedge funds have seemingly limitless investment options available to them, they are able to rake in those profits for their investors. However, the incentive structure can lead to a conflict of interest between the hedge fund manager and the investors. As the manager, instead of being careful with the investments, they may take excessive risks or engage in unethical practices to boost their own compensation. Hedge funds also have a reputation for being aggressive and secretive, using their vast resources and network of connections to gain an edge over other investors and manipulate the stock market. Short selling, in particular, is a popular strategy among hedge funds, as it allows them to profit from the decline of a stock's price. Unfortunately, it often leads to a vicious cycle of selling pressure and negative publicity, which can harm the target company and its stakeholders. More on short selling later in the video, but for now, let's move on to brokers. Brokers are another powerful player in the stock market. They are intermediaries between investors and the stock market, facilitating the buying and selling of stocks and other securities, and earning commissions and fees from both sides. They also have a duty to their clients, which includes providing them with fair and accurate information, executing the trades promptly and efficiently, and disclosing any conflicts of interest that may affect their recommendations. Unfortunately, some brokers have been known to do anything to ensure that those commissions keep coming in. A number of them engage in unethical or illegal practices, such as front-running, buying or selling a security before a client's order to profit from the price movement, churning, excessive trading to generate more commissions, or inside trading, using non-public information to gain an unfair advantage. Next, we have regulators. Regulators are also big players, but unlike the other players mentioned already, regulators are government agencies. They are responsible for overseeing the stock market and ensuring that it operates in a fair, transparent, and efficient manner. So they have the power to investigate and sanction market manipulators, enforce rules and regulations, and protect investors from fraud and abuse. However, regulators are often criticized for being ineffective or captured by the industry they're supposed to regulate. They typically lack the resources, expertise, or political will to pursue complex cases or hold powerful players accountable. In some cases, regulators may even collude with the market manipulators or turn a blind eye to their misconduct, either due to corruption, incompetence, or regulatory capture. So, basically, hedge funds use their capital and strategies to bet against companies and manipulate the stock prices. Brokers facilitate these trades but are usually more concerned about earning commissions and fees, and regulators are supposed to oversee the market and protect the investors, but often fail to do so. While stock market manipulation may seem like a victimless crime, the reality is that its impact can be devastating for ordinary people who invest their hard-earned money in the hopes of achieving financial freedom and growth. For one, financial losses in the stock market can have a significant psychological toll on individual investors and their families. When someone loses a significant portion of their savings or investments, you can imagine the range of negative emotions they would be experiencing. In addition to the loss of peace of mind, people have actually lost their money. And for a number of those people, that money was their life savings. Money they were setting aside for something important. Money they hoped would grow by making what they considered to be the right investment decision. One of the most prominent examples of retail investors losing their savings due to market manipulation is the Enron scandal. In the late 1990s and early 2000s, Enron, a Houston-based energy company, engaged in fraudulent accounting practices to inflate its revenue and hide its debts. Many retail investors, including Enron employees who had invested heavily into the company's stock and 401k plans, lost their life savings when the truth was revealed and the company's stock plummeted. Another example is in the 2008 financial crisis, which was caused in part by the manipulation of mortgage-backed securities by investment banks and hedge funds offering subprime lending. Many retail investors who had invested in these securities lost their savings, while the banks and funds that had engaged in the manipulation eventually received government bailouts and continued to profit. In addition to actually losing money, the fear of losing money can lead investors to make irrational decisions, such as selling their stocks at the worst possible time or avoiding the stock market altogether. This can further worsen their financial losses or prevent them from making extra income in the market that should have been relatively safe. Retail investors are not the only ones that lose out, though. Companies that are targeted by short sellers can and have also suffered from reputational damage, reduced revenues, and lower valuations. For instance, in 2020, short sellers targeted electric vehicle maker Nikola Corporation, alleging that the company had misled investors about its technology and capabilities. The resulting negative publicity caused Nikola's stock price to plummet, and the company was eventually forced to admit that some of the allegations were true. Also, in 2020, a short seller firm, Wolfpack, targeted Chinese internet company iQIYI, alleging that the company was engaging in fraudulent accounting practices, inflating user numbers and revenue. The resulting negative publicity caused iQIYI's stock price to drop, and the company was eventually forced to launch an internal investigation into the allegations. The impact of stock market manipulation extends beyond individual investors and companies, however. The instability and inefficiency of the stock market can also undermine its role as a source of capital and innovation. When investors lose faith in the market's fairness and transparency, they may be less likely to invest in new companies and technologies, which can stifle economic growth and development. It is obvious that real people and companies suffer from the manipulation of the stock market, but you're probably curious about how the manipulators manage to do what they do. Well, that's what we'll be looking at in the next chapter. One tactic the manipulators use is something called short selling. Short selling is a popular method used by hedge funds to bet against a company's stock price. They borrow shares of a company, sell them in the market, and hope to buy them back at a lower price later, therefore pocketing the difference. While short selling is not inherently illegal, it can become a tool for manipulation when hedge funds use it to spread negative rumors or false information about a company to drive its stock price down. A prominent example of this tactic was seen when Bill Ackman's Pershing Square Capital Management famously shorted nutritional supplement company Herbalife in 2012. Ackman publicly accused Herbalife of being a pyramid scheme, claiming the company's business model relied heavily on recruiting new distributors from low-income and minority groups rather than selling products to customers. He argued that Herbalife's financial statements were fraudulent and that the company's stock was worth zero. The short position caused a lot of controversy, with Herbalife going full FBI on Ackman. The short position on Herbalife ultimately proved to be unsuccessful for Ackman, as the stock price did not drop as he had predicted, and he was forced to cover his position at a loss. But there was some initial dipping of Herbalife's stock value when Ackman made his opinion public. Another common tactic used by market manipulators is pump and dump. This is when they artificially inflate the price of a stock by spreading false or misleading information and then sell it before it crashes. This tactic has been around for a long time, but with the advent of social media, it has become easier to spread misinformation on a massive scale. In 2014, a scandal surrounding the penny stock company Sync Technology is a perfect example of this tactic in action. The company's stock price rose from less than 10 cents to more than $21 in just a few weeks, based on false claims of a revolutionary new social media platform. The scheme was found out, though, so the price eventually crashed, leaving many investors with huge losses. Insider trading is perhaps the most blatant form of market manipulation, where traders use confidential and non-public information to gain an unfair advantage over other investors. In recent years, there have been many high-profile cases of insider trading, including the infamous case of Raj Rajaratnam, founder of hedge fund group Galleon Group. In 2009, he was convicted of using insider information to make millions of dollars in illegal profits. High-frequency trading and algorithmic trading are other methods used by market manipulators to gain an unfair advantage. These strategies use powerful computers to execute trades at lightning speeds, giving traders the ability to profit from even the smallest market movements. While these practices are not illegal, they've come under scrutiny in recent years due to concerns about their impact on market stability and fairness. Finally, the use of social media and other online platforms has enabled new forms of market manipulation, such as fake news and troll armies. By spreading false information or creating artificial buzz about a stock, manipulators can drive up its price and then sell it for a quick profit. For some reason, people are willing to listen to influencers on any issue, even if they obviously have little to no knowledge on how the stock market works. So this tactic has been really effective. What's worse, because the regulators do not do what they should, these manipulations will only continue to happen. But every once in a while, salvation has come from the most unlikely places. That's what we'll be looking at in this next chapter. One of the most unlikely places is Reddit. Well, really, Reddit can be anything you want it to be. But in the case of the GameStop Saga, it was the salvation that GameStop didn't know it needed. It all started when a group of amateur traders on Reddit's Wall Street Bets forum noticed that several hedge funds had taken large short positions on the video game retailer GameStop. The Wall Street Bets traders saw an opportunity to turn the tables on the hedge funds and launch a coordinated attack on their short positions. They used the popular trading app Robinhood, among others, to buy up shares and options of GameStop. This triggered a massive short squeeze, driving up the price from under $20 to over $400 in a matter of weeks. The hedge funds were forced to buy back the shares they had borrowed at much higher prices, which served to further push the price of GameStop stock, which resulted in massive losses for those hedge funds. Some of them reportedly lost billions of dollars in the process. The GameStop phenomenon was not just about making money. It was also about sending a message, challenging the entrenched power structures of the stock market, where hedge funds and institutional investors have long dominated the game. The Wall Street Bets traders saw themselves as a new kind of investor who could use the internet and social media to disrupt the status quo. The GameStop saga has raised many questions about the nature of the stock market and the role of retail investors in it. Some have praised the Wall Street Bets traders as heroes who stood up to the Wall Street elites and exposed the flaws and inequalities of the system. But others have criticized them for engaging in risky and irresponsible behavior and for potentially causing harm to innocent investors who got caught in the crossfire. The GameStop saga has also put a spotlight on the regulatory challenges of the stock market and the need for more transparency, accountability, and fairness. The Securities and Exchange Commission, SEC, had to propose new rules to get hedge funds to be more transparent about material events, including their extraordinary losses. In addition to that, the GameStop saga has led to some people calling for stricter regulations on short selling, high-frequency trading, and other forms of market manipulation. Others are calling for more democratization of the stock market, where retail investors have a more equal footing with institutional investors. The GameStop saga has shown that the stock market doesn't have to just be a game for the wealthy and powerful. It is also a place where ordinary people can make a difference and challenge the status quo. Sure, there are risks and challenges associated with such endeavors, but when the regulators are inefficient or decide to side with the market players, what can the regular investor do? In conclusion, the stock market has long been a complex and often murky arena, with hedge funds, brokers, and other actors using various tactics to manipulate prices and profit at the expense of others. This has had a devastating consequence for individual investors and the economy as a whole. However, recent events have shown that people can still fight back and challenge the power of the financial elite. The future of the stock market remains uncertain, but one thing is clear: it will continue to be a site of struggle, innovation, and disruption for years to come.